Good day. I'm Marius Cornelissen, Partner and Portfolio Manager at PSG Wealth Menlyn. Let's have a look at some of the factors that have impacted global financial markets over the last few months. Well, first off, COVID-19 does not seem to be going away, especially in China. Currently, more than 200 million people are still in some form of lockdown, and it's not going away. It's having a significant impact on their GDP. The property sector is still under pressure. One of the main news items has been inflation. Global inflation has been skyrocketing with record inflation rates in the UK, US, Europe, and South Africa. In the UK, it's been a revolving door with some big political ruptures there. They've now had 5 prime ministers in the last 6 years. It's been a revolving door, and we'll see how long the current one lasts. The war in Ukraine is still ongoing, obviously, with impacts on global financial markets. The main news flow has, however, been global inflation. Inflation has been a scourge, with the rates reaching levels we've not seen in decades. The US inflation rate is currently running at over 8%, and South African and European rates are also quite elevated. Now, what happens when inflation rates go up? We know it. Interest rates go up as well. The big drops that we saw in interest rates that happened after COVID has now been reversed, with interest rates reverting back to the levels we saw in 2019 and 2018. With that, however, we're still looking at high inflation. We're still looking at interest rates that might go up quite a bit more. But there's some good news. Brent crude oil has dropped. It's now back to the level we saw before the invasion of the Ukraine. It was as high as $130 a barrel, but the last few months has been good. And that means better news on the petrol price front. One of the big other impacts has been food prices. Prices of sunflower oil and wheat skyrocketed as the invasion took place. But again, just like oil, it's come back down over the last few months and back to the levels we saw pre-invasion. Well, if there's one thing we know as well, it's that coffee is nice, but coffee has become very expensive. Over the last few years, the price of coffee has increased remarkably. But over the last month or so, it's been plummeting, and is expected to do so going forward. There was good rainfall and very good crops from some of the major producers, meaning that the price you will pay will soon be a lot lower. Well, food prices has been rapidly increasing over the last few years, especially after the invasion. If we, however, look at the United Nations Food and Agricultural Organization Food Index, we'll see that over the last 3 months, food prices have started dropping. That is good news. So what are we seeing? We're seeing lower energy prices, we're seeing lower food prices, and what does that mean? It means at the end of the day, inflation expectations will probably be lower. The strong US dollar has been one of the main talking points of 2022. Initially, after the Russian invasion of the Ukraine, the rand strengthened from just over the 15 it was at the start of the year to around about 14.50 against the US dollar, on the back of increasing commodity prices. However, from about May onwards, the dollar has been on a tear. The rand's weakened to over 18 against the dollar, and has been quite volatile in the process. We might think it's just a South Africa story. Blame Eskom, blame the political situation or the water situation. It's not. The dollar has also been extremely strong against most other major currencies. The Japanese yen is at over a 30-year low, and as you can see, it's been extremely strong against the euro and the British pound as well. With all of this happening, markets have been volatile. The JSE All Share Index just over the last 6 months has oscillated quite often between the lower 60,000s and the higher or early 70,000s. In September, the markets were under pressure, locally as well as offshore, but October has been a good month, with the local market as well as the offshore markets picking up ahead of steam. In the US, if we look at the Dow Jones, a similar story took place. The Dow did quite well in August, ran up to over 34,000 again, but then plunged in September to about 29,000. Over the last 2 weeks, it's been quite strong over as corporate earnings has been quite good in the US, and the economic outlook and the inflation situation seems to be getting better. One of the main factors affecting global markets, and especially the US markets and the lack of performance, has been technology shares. Leading the way was Meta, the owner of Facebook, Instagram, and WhatsApp. Over the last 6 months, the share price has dropped by over 55% on the lack of bad earnings. The titans of Wall Street are all quite unhappy with Mark Zuckerberg at this stage, saying he's on a money-spending binge and not showing any return for it. However, it's not just been Meta that's been under pressure. If we look at Amazon, Microsoft, Tesla, and Alphabet, they've all had a torrid time. The earnings have disappointed. The outlook has worsened. It's still high-quality companies, but we'll see what the future holds for all of them. Looking ahead, if we say to ourselves, well, inflation expectations, they're looking better, but it's still high. Interest rates in the US and locally are still expected to increase over the next couple of months. Wouldn't we be better off sitting out and moving to the sideline? Well, that could be problematic. We've seen in the past, and news flow is bad, markets go down, but they pick up quicker than we anticipate, and they pick up a lot sooner than we anticipate. In March 2020, while COVID was running through the world, we saw financial markets dropping quite a bit. The JSE bottomed at 38,000 on the 19th of March 2020. What makes that interesting? Well, at that stage, we could still buy cigarettes, we could still buy alcohol, and we could still even buy open shoes. The president announced lockdown on the 23rd of March, and they locked us up on the 26th of March. At the end of April, we were still in a hard lockdown. But by that stage, the all-share index had already recovered from the 38,000 level to 50,000. At the end of the year, when the second wave hit, the market shrugged it off and went to 59,000. So despite the bad news flow, the market recovered because the market was looking ahead. The same thing happened in 2009 after the global financial crisis. In March of 2009, the JSE All-Share Index hit 18,000. That wasn't good. We only saw positive economic news coming out in the middle of 2010. Yet, by the end of 2009, the JSE All-Share Index had already increased by more than 50% from the lows of March 2009. Markets look ahead. It's very easy to get distracted by a bear market. There have been numerous in the last 100 years, some of them quite big, some of them smaller. The current one has been a significant one. If we look at the S&P 500, it dropped by more than 25% in the current bear market. However, if we look closely at previous bear markets, we'll see that they are usually followed by very good markets. When that happens, you want to be invested. You want to be there because you want to catch that bull. What keeps me awake at night? Well, numerous things does. We still live in uncertain times. The war in Ukraine is still ongoing, with the volatility that that brings. We've also got China with the zero COVID policy and their property market that is a factor in 2023. Global central banks might also overshoot with their interest rate hikes, which could produce further volatility for markets. In the UK, with the rising interest rates, we've also seen that the great reset in the home loan market is going on. Interest rates on home loans will, for millions of borrowers, increase from around about 2% to 6%, making property ownership a lot more expensive. On the local front, we've seen Eskom. Well, we're all worried about Eskom. There are water shedding issues that's plaguing us, and of course, local political instability with some of the coalitions that doesn't seem to be working, and of course, the ANC leadership election that's looming in December. Last but not least, unemployment is still an issue with the demographics that go along with it, and of course, crime. What, however, gives me hope? There are opportunities given the weak markets. The rand should be stronger going forward. We're probably looking next year at it recovering, and in the next year or so, moving back to a level of around about 15.50. That should lead to lower petrol prices, and obviously that should lead to lower inflation. Lower food prices, or more stable food prices, should also be on the cards, and inflation is set to moderate not just locally but overseas as well. The interest rate cuts, as the recessions in Europe and the US confirmed, should start taking place from the end of next year into 2024. So for now, maybe some more rate increases on the cards, but as inflation goes down, that should be reversed in the next 12 or 24 months. The most important thing, however, is valuations are cheap. The JSE All Share Index has over the last 20 years only been lower in 2009. Valuations offshore are also quite lucrative at this stage. The S&P 500 forward P is the level of around about 15, which is not on the expensive side. For us, the story remains one of being realistic, tempering our expectations, and diversifying. If you have any questions or want to discuss your investments with us, please feel free, as always, to email, phone, or make an appointment. Good day.